Good morning and welcome to today's webinar, which puts the spotlight on JPMorgan Asia Growth and Income. Thank you for your patience in a slight delay to the start. I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and today we're joined by Rob Lloyd and Pauline Ng, managers of JAGI, to present an update on the trust. Now, just before we begin, it's a couple of bits of housekeeping. We recommend having the WebEx app for the best experience, including being able to view the slides. And if you are having any difficulties, please use the chat function. Or if you're having difficulties with the audio, have a look at the audio settings in the screen. Finally, if you do miss anything, a recording will be available on the website afterwards, as well as the slides, which will be available to download as PDF. Now, we'll soon hand over to Rob and Pauline, who will speak for around 30 minutes on the trust and in the backdrop of Asia as well. And after that, we'll have around 15 minutes of Q&A, where you'll be able to ask some questions as we go along, and we will put these to the managers at the end. So without any further ado, Pauline, Rob, please take it away.
Great, thank you very much. Maybe you can just turn to the next slide. Great, I'll just give you I'll give the audience an executive summary of some of the main points for the investment trust for JAGI. So we focus on investing in innovative and technology areas across Asia. We take an active, conviction-led approach to investing in profitable companies that demonstrate growth potential over the long term. I think this is really important. The second point is, with nearly 50 years of combined experience, portfolio managers, myself, and Pauline, we bring extensive local expertise investing on the ground. I'm based in Hong Kong and Pauline is based in Singapore. And we leverage a comprehensive and seasoned research network with over 100 dedicated investment professionals. And then I think the last point, another attractive attribute of the trust is the quarterly enhanced dividend provides shareholders with income while avoiding placing any constraints on Pauline and I in terms of our pursuit of companies that offer compelling long-term growth prospects. Let's turn to the next slide. Great, so I'll just provide an overview of the current positioning of the fund. So we'll just take a couple highlights here. Just on the top left-hand side, you can see that the fund relative to the index is overweight communication services. This includes a number of different types of companies, but I would just highlight maybe one off-benchmark position that's included in the trust, that's held in the trust. It's called Telstra. This is an Australian telecommunications carrier. It has a massive network advantage in Australia. So essentially, if you're living outside the major cities, you really have one option. Mobile users have one option in terms of high quality network coverage. And with this advantage, with this network advantage, the company is able to consistently raise pricing. The other point too is that their competitors barely cover their cost of capital. And so we think over the long term, the industry structure allows Telstra to raise prices and distribute excess capital to shareholders such as yourselves. This is really a long-term, our view here is to hold this for the long term and really gain from what is around a 4 to 5% dividend yield in Australian dollars that we can generate plus growth over the long term. And then in financials, we break it down into a few subcomponents. I'll just highlight, which I think is an important aspect here, is the diversified financials services. This mainly includes exchanges. And I'll just highlight a couple names that I think are important. The first is Hong Kong Exchange. Hong Kong Exchange, like most of these exchanges that we own in the portfolio, these are effective monopolies. And in terms of Hong Kong Exchange, there's a couple key drivers. The first one is an initiative called Stock Connect. I think a lot of investors are aware of this, but basically what this does is it facilitates trading from mainland Chinese investors into offshore Hong Kong dollar names. And so far this year to date, we've seen a record level of turnover, around $75 billion has turned over from mainland investors investing in Hong Kong listed names on Hong Kong Exchange. The second point is an increased IPO activity and pipeline of Hong Kong dollar dominated Chinese businesses. So we've seen over the last couple of months, companies like BYD and Xiaomi, they're issuing Hong Kong dollar equity rather than on the mainland. This facilitates a number of different options. But another point here to highlight is regulators increasingly are preferring companies to issue equity on Hong Kong exchange rather than ADRs. We see this opportunity as driving growth over the long term. In fact, you could see recent results from Hong Kong exchange have been very strong, and we expect these trends to continue. The overweight in banks is really a function of the individual opportunities we find across the region. It doesn't necessarily imply that Pauline and I are taking some sort of view on the level of interest rates, either in the United States or regionally. It's more looking at the individual opportunities that we find across growth markets like Indonesia and India, where we hold positions in banks. I'll just focus on a couple underweights. So in terms of consumer discretionary, that's the largest sector underweight in the fund. And the big driver here really is around the automotive sector, especially in electric vehicles in China, where although we see huge top line growth potential from the likes of BYD, Xiaomi, and a number of other companies, our main concern is that we think the industry profit pool won't grow at the same rate. And the level of invested capital will mean over the cycle, returns on equity will be fairly low. And we think that investors are not pricing this in as they're more focused on top line growth. If we just look at the bottom there in terms of the country allocation, you can see that the largest overweight is the off benchmark position in Australia. So I touched on that earlier in terms of positions in Telstra, for example. And then secondly are the overweights in South Korea. We still think that the market in Korea is undervalued. I think in previous webinars, we've touched on the poor performance of the Korean market over the last couple of years. We think it's very undervalued, and we think investors are underappreciating the potential for value up initiatives to create value for minority shareholders over the medium term. India is a slight overweight, as well as Indonesia. We see long-term growth potential in both markets. I touched on just a bit earlier on banks. So we hold Indonesian and Indian banks within the country to capture the growth opportunities in those markets. And you can see China and Hong Kong, they're effectively neutral positions. So again, I mentioned some of the underweights, such as the EV sector, and that's complemented by or offset by overweights in names like that are familiar with investors such as Alibaba or Tencent. And then you can see there's a slight underweight in Taiwan. The largest holding in absolute terms is still Taiwan Semiconductor, but we're underweight a kind of a long tail of medium and small cap technology companies in Taiwan, which we think are overvalued. Let's turn to the next slide, please. So we can see here on slide 5, again, I touched on this, TSMC is the largest holding. In absolute terms, it's almost 13%. That's around a 2.5% active position versus the index. Then you can see on the right-hand side, the active positions versus the index. So this really starts with Hong Kong Exchange, Alibaba, Telstra, Taiwan Semiconductor, and Kotak Mahindra Bank. We touched on these a little bit in the earlier slides. And then just in terms of the underweights, Xiaomi, which again, we touched on the fact that we're underweight the EV supply chain and automotive makers in China. Chinese banks were underweight, as well as names like Pinduoduo and AIA. Let's turn to the next slide. Just looking at the characteristics of the portfolio, one thing maybe to remind viewers and investors is that the approach Pauline and I take is really based on stock selection, bottom-up stock selection. We're not taking large country bets or sector bets, as you could see from the previous slides. So this really drives the kind of overall characteristics of the fund, where you can see that the fund's valuation is relatively close to the index in terms of a slightly higher price to earnings ratio, a slightly higher price to book ratio, and a dividend yield that is comparable to the index. And for these valuations, we're getting slightly higher returns on equity. We own companies that are on average have better balance sheets than the index, and we're getting a bit better growth than the overall index. And the fund holds around 60 stocks with an active share of 64%, a tracking error of 3.7, and a beta just above 1. I think one thing to highlight here, just on the bottom right, is the market capitalization. You can see on the very bottom right side that the fund is overweight mega caps, underweight large and mid caps, and overweight small caps. And I think we touched on this just in terms of earlier talking about our JPMorgan Asset Management strengths of having local expertise on the ground in Asia. As I mentioned myself, I'm based in Hong Kong. Pauline is in Singapore. And we really do a lot of company visits, local conferences where we look for opportunities that we think are underappreciated by investors in the small and mid cap area. And you can see there around 7% of the fund is in small caps, complemented by 1.4 of even smaller companies relative to being underweight mid and large caps. We can turn to the next slide, please. One thing I'd like to highlight here in terms of the performance, you can see on the bottom part of this page, this slide, the fund has only underperformed in 2 out of 10 calendar years. I think one of the points that I mentioned just earlier is Pauline and I focused on bottom-up stock selection. We're not taking top-down market views or country views. And so I think that's resulted in performance that's not really correlated to the direction of markets. So you can kind of pick any periods where the fund is outperformed in up markets and outperformed in down markets. I think where we struggle occasionally, where we had down markets like where the fund underperformed in 2023 or in 2020, is when we see very strong style characteristics in markets. For example, markets go to extreme value or extreme growth. This is where the stock selection philosophy and driver of performance can struggle in those times. Maybe we can just go to the next slide, please. I just like to highlight here, we've used these slides before, but just in terms of the country performance. So you can see on the left-hand side, this was calendar year in 2024. These numbers are in US dollars. So you can see Taiwan, Singapore, and Malaysia were very strong performers. I think it's probably not a big surprise to viewers that Taiwan is a strong performing market, really driven by the trends in artificial intelligence. And you have companies in that market like Taiwan Semiconductor, MediaTek, ODMs that have performed extremely well on the back of these fundamental drivers. And then on the bottom there, you can see Korea and Indonesia. Korea has been a poor market, really driven both by poor results, the cyclicality of the market, and a little bit of a couple of years ago, expectations that were a little bit elevated in terms of the value up initiatives. And then you can see Indonesia really driven by slower growth, concerns around politics, and a weakening currency. This year, it's quite interesting to note that you've seen a reversal in some cases. So you can see Taiwan has underperformed. The market's down 10% in dollar terms. Indonesia continues to be weak, but is looking to stabilize. And Singapore is actually the strongest performing market in Asia. And this is really driven by some kind of unique aspects of the market where there are some large technology companies where they're headquartered in Singapore, but their businesses are really being driven by growth in areas such as Southeast Asia and Indonesia. And I just also highlight the turnaround in China. So again, China had a strong year last year, rising 20% in US dollar terms. And year to date, China is up 10%. We can go to the next slide, please. I'll just highlight the attribution. So this is really year to date. The fund is about flat versus the index. You can see the attribution. India has been a big driver. So stock selection has improved considerably where we struggled the last couple of years, but this is starting to turn around as we continue to add resources, add coverage to our list of companies. And I think this has really contributed to better performance more recently. And then underweights in Thailand have added value. We don't own any names in Thailand. And then maybe just a few detractors there. Indonesia, we still like the long-term story in Indonesian banks, where we think they can grow 10 or 20% over the long term. But in the near term, the economy slowed and the stocks have derated. And then I just highlight Taiwan. So again, we own the largest holding in the fund is Taiwan Semiconductor. And this is derated along with the concerns around maybe potential overspending in the AI area, as well as potential concerns around Taiwan Semiconductor's capital allocation. We can turn to slide 13 actually. And great. So this is a couple of names we talked a little bit about in terms of for 2024. I just highlight, we talked about Foxconn Industrial. So this is essentially the China listco of Hon Hai, which is an ODM, and the real big driver of this company's returns over last year, which the stock rose nearly 70%, around 70%, is really driven by their assembly of data center racks. So as companies, as the cloud service providers are building out their data centers, they are supplying, or they're using contractors such as Foxconn to build racks. And there's a couple of other technology companies in here. We mentioned Taiwan Semiconductor, also Hynix, which is a leader in HBM, or high bandwidth memory. This is also, AI has also been a big driver. And then just on the right-hand side, I just touch on a couple of names that have detracted. So Xiaomi, so we touched a little bit earlier on where our outlook on the EVs supply chain and EV makers in China is cautious. Despite that, Xiaomi's share price has been very strong, and it's outperformed along with a couple other names, and that's detracted to performance. And then I just touch on maybe AIA and some insurance companies in China, which have underperformed as interest rates have fallen over the last year or so. We can go to the next slide, please. I'll hand this over to Pauline.
Well, thank you, Rob. So Rob has shared a lot with you on the JAGI positioning, how the fund is actually positioned different opportunities. So I want to actually zoom out and make the case for why Asia. So when you think about Asia, we believe that Asia is a fantastic place for bottom-up stock picking investment. And JAGI precisely is a high conviction bottom-up portfolio. So think of Asia as really having many different kinds of economies. On the north part of Asia, we are obviously very strong in technology and innovation. When you think about South Asia, that includes places like India, Southeast Asia. These are places with huge population, where penetration in a lot of areas are still very low, and where domestic consumption and the growth of the middle class will drive a lot of the long-term growth story in South Asia. But today, I want to spend a little bit of time focusing a bit more on technology and innovation. I think it's also a fantastic time to talk about that, given what we've seen with all the news flow on the tariff and on all the technology implication, chip bans from the US to China, right? So on this slide, you can see on the left-hand side, North Asia countries like China, Taiwan, South Korea, they are huge countries in terms of the supply chain. And therefore, as a result of that, we are also finding a lot of opportunities in terms of the technology. Moving on to the next slide. Oh, okay. So before that, maybe back to the other slide, sorry. So the slide is slightly different. Okay. So when technology, I really want to talk about the recent trend in terms of DeepSeek. I think in January, when DeepSeek was launched, it was a huge moment for the entire technology supply chain. And China demonstrated to the world, even with all the controls of NVIDIA chips, they were able to come up with a solution that has got fantastic compute power at much lower cost. That sort of opened an entire debate around this whole AI technology, who will be the winners, right? Some of these areas of debate really focus on two core areas. Number one would be GPU versus ASIC. ASIC stands for application-specific integrated chipsets. We believe that ASIC could see very strong growth in the next couple of years as inferencing demands actually pick up. On top of that, clearly the market has also put in a lot of high expectations on the GPU side. I think over the long term, you will see both continue to grow, but in our opinion, that there's potentially more upside from the ASIC side. The second area of debate really centers around data center capex versus edge devices. Edge devices would be things like your PCs, will be things like your smartphones. And we have also looked at some of the US hyperscalers that have reported post the 1Q25 results. We have seen companies like Meta actually increase their data center capex by close to 15%. Concerns around Google or Microsoft cutting their data center capex actually didn't quite play out. So I think that underpins the sort of long-term growth. On the other hand, in terms of the edge devices, we're still on very early days. But again, we believe that the market may be underestimating some of the use cases that will play out in the next couple of years. But more importantly, throughout this sort of debates, whether it is GPU versus ASICs, whether it's data centers versus edge devices, there's one clear winner from our point of view, and that's TSMC. The fund is very unique in that we can have an overweight position in TSMC. TSMC continues to lead in terms of the leading edge technology. They have close to 90% market share. If you look at in terms of the AI component of the earnings of TSMC, that is growing at 40-55% CAGR as we see. So I think TSMC is a clear-cut favorite for us in terms of playing this whole technology story in North Asia. The next slide, please. So when we talk about innovation, we deliberately wanted to use an example where it is not a hardware supply chain company. So Naver here is actually a Korean internet conglomerate. They have search business. They, of course, have e-commerce business as well. And over the last couple of years, the stocks have actually underperformed and derated quite a fair bit. On the search side, there were a lot of concern with regards to their business model being disrupted by ChatGPT, by YouTube, by a lot of all these in-app searches, which affects their search. On the e-commerce side, Naver is also a company that has been disrupted by two companies, right? On one hand, we have a companies like Coupang, where it offers fantastic services to the end customers, a little bit more on the higher end side. On the lower end side, they've been disrupted by value-seeking customers that prefers to shop in terms of places like Temu and Shein that offers very, very low-cost product. But what we are seeing is that this is a company that is not standing still. They are continuing to innovate and change. On the left-hand side, I appreciate it might be a little bit difficult to see. They have developed some of their in-house widgets and apps to sort of make sure that they are seeing the growth, recapturing some of the market share loss in the last couple of years. So on the right-hand side, you see in terms of the overall revenue of this company, as well as the e-commerce, we're seeing an inflection. And the stock has derated massively, and that has allowed JAGI to have this idiosyncratic opportunity to own Naver as a company in the trust. Next slide, please. So China. So I think when we talk about China, have issues to be discussed. Obviously, the slowdown, the issues in the property market, the tariffs as we speak, and the aging population. These are all widely known issues. We have a tariff truce over the weekend. So the tariffs have been reset down to 30% or so for the next 90 days. We will await to see more news flow coming out on that front in terms of what the long-term solution and the negotiation between US and China will be. Amidst all this uncertainty with the tariff, there are companies that stand out and will continue to do well regardless of what one wants to assume on the tariff side. So Hong Kong Exchange is a company that Rob has spent a bit of time talking about it. So I really don't want to elaborate except to say that it is an integrated monopoly. It is capital light, it's cash generative, and earns very high margin. So this is one of the core overweight for JAGI. On the other side, we have NetEase. So NetEase is a leading innovator in China PC mobile gaming industry with best-in-class governance. It is also the first company in China that have a stated dividend policy. The stock has actually struggled in 2024 due to a slowing industry growth from double digit to mid-single digit. And also at the same time, NetEase did not have any new blockbuster new games released in 2024. So the stock has derated, which again allow us that opportunity to invest in this company when the valuation is very attractive. As we speak this year in 2025, the companies are launching new games, and the traction that we're seeing on the ground has been very, very encouraging. Next slide, please. India. So historically, India has been a more problematic area for JAGI in terms of the performance. It's been a detractor for us. I would say that we have, as JPMorgan as a house, has invested a lot to expand the coverage, both in terms of the breadth as well as the depth of our Indian coverage. Today, we cover close to 200 stocks in India. We cover predominantly all the stocks that are already in MSCI India. But what has been stopping us from being more optimistic about India clearly has been devaluation. On the left-hand side, you can see this is a market that has compounded and has done very well. In the last couple of months, we have started to see earnings have started to disappoint relative to consensus, and share prices have also started to come down, which is giving us an opportunity to run a small overweight in India at this point in time. As we speak, in terms of the current results season, 50% of the Indian companies have reported results. We are still seeing some earnings downgrade. I think if you look at 2026 expectation, financial year March 2026, that is, we have seen MSCI India earnings expectation being cut from the start of the year was running at 13 to 15%. It's now being cut more to 10, 11%. And that sort of reset has bring expectation down, share prices come down, and valuation down, and that's giving us opportunity. And here I want to actually highlight an investment that we do like. This is Godrej Consumer Products. Again, a turnaround story in our opinion. The last 5 years earnings growth has been very, very lackluster. They have a new CEO that came on board about 18 months ago, and we're starting to see some of the positive impact of the reorganization of this company. So in short, this is a company that has 40% of their revenue in home insecticides. And about 12 months ago, they actually launched a new formulation for mosquito repellent. And they're now seeing very strong double-digit growth as a result of this new molecule that's highly effective, cost-effective in terms of being the best performing mosquito repellent in the market. So this is a company that I think we're seeing a strong turnaround. And remember when we talked about technology and innovation really happens across multiple industries, right? We highlighted Naver, what they're doing. That's on the new economy side. On the sort of old traditional economy, like consumer product, we are also investing in companies that are innovating to drive the growth going forward. So with that, I will hand it back to Rob to give a quick summary and an outlook.
Great, thanks, Pauline. Let's go to the next slide, please. Yeah, okay, so here on slide 19, this is a composition of returns for global markets. So you can see last year, the United States, obviously a very strong market, up 25%, and then followed by Japan, Europe, EM, and Asia Pacific. The chart there on the right-hand side, the year-to-date performance, that's up to the end of, that's up to, I think, April 8th. So if we look, you can see that markets were generally down, except in terms of have derated a year-to-date. If we look up until yesterday, actually, you know, you've seen a big recovery in markets. In fact, the S&P 500 is now, I think, flat year-to-date. And Asia, in fact, is up 8%. So, you know, obviously with what's happening in terms of tariffs and trade negotiations, market sentiment has changed dramatically. Let's go to the next slide, please. Just on tariffs, I mean, I think the main point here to focus on is that tariffs are creating uncertainty across the US and global markets, and they're risking either slower growth or even in some cases, potential recession. This is also essentially in terms of the tariffs capping US dollar upside, which more or less is relatively positive for investors looking to diversify into areas like Asian markets or emerging markets. I think the other point too is obviously in terms of China, is growth could slow with higher tariffs. And this could weigh either on the ability of policymakers to stimulate growth and to try to calibrate domestic policies that could offset some of these higher tariffs. Although, as we just touched on, you know, maybe tariffs might not be as high as originally expected. Let's actually turn to slide 26. Just like to touch here just on China. So as viewers may recall, if we look, China in the investment trust, including Hong Kong, is more or less neutral. And the outlook, this really reflects both the bottom-up opportunities that we're looking for in China, as well as the top-down and macro environment. So I think there's a few points here to highlight. So the first is really the outlook in terms of consumption and growth is fairly fragile. You can see that consumer confidence hasn't recovered. I think a lot of investors and viewers have heard anecdotes like youth unemployment is very high or at record highs. You can see also on the right-hand side that inventory of property remains very high. We started to see a slight improvement in tier one cities property prices in the secondary market, but more or less the market remains kind of sluggish, and we see this kind of muddle through scenario in terms of the economy. Let's just go forward a couple more slides. I think 28. Yeah, there we go. Now, I think in terms of, investors are well aware that the outlook for China is mixed, and this is being priced in terms of valuations. You can see that China's a little bit below its average price to earnings ratio. I think one of the positives that's not often discussed is on the next slide. So you can see on both charts here that one thing that's happening, or one improvement, is in terms of governance. So there's a slight improvement in governance in China. And if you look at the right-hand side, if you look at the what we describe greater capital discipline, so you can see net issuance as a percentage of market cap. So in terms of the United States, companies consistently buy back their own shares. And really, it's only recently where in China, on a net basis, that companies are buying back shares, where in the past, you've seen essentially dilution as companies, essentially they issued increasing amounts of equity to fund either growth domestically or overseas. And this is starting to change. And I think this, again, we look at China from a top-down and bottom-up perspective. So the top-down outlook is relatively mixed in terms of consumer confidence remains weak, and the property market hasn't really recovered. But this is offset by bottom-up factors such as improving governance amongst Chinese companies. I think that's the main parts of the outlook that I'd like to highlight. I think we'll move to Q&A now.
Thank you very much, Rob and Pauline. We are having a couple of issues with Q&A, so fortunately we've had some questions come in via email, so we'll address those. One of them actually does start with China, so we'll kick off there. You've talked about some of the weak consumer sentiment. There were some stimulus measures at the end of 2024 to try and address this. Do you think that there is scope for further stimulus measures in 2025? And if so, what areas could this affect?
Yeah, I think it's a good question, and it's an important topic that a lot of investors are focused on. Yeah, I think that policymakers are kind of reluctant to, embark on what investors kind of call the big bazooka or bazooka stimulus. And I think the reason is really in the past, these large levels of stimulus really backfired. So if you think about it, most of these types of policy measures were focused on either the property market and infrastructure, and these measures resulted in overcapacity. And kind of similar to what happened in Japan in the 90s and early 2000s, a lot of this has resulted in deflationary outcomes for a lot of these sectors. And I think policy makers realize that there's this unintended consequence or risk of embarking on or doing too much stimulus. I think really the policy measures really are, I think from a bottom-up perspective, are the most interesting areas to focus on. We talked about improving corporate governance, where companies are on a net basis, they're buying back shares. I think it's not necessarily a top-down directive, but I think now the government is more understanding of companies encouraging companies to improve their shareholder returns and their governance. And we see this across the region in Japan and Korea, as we touched on. And I think the other big kind of policy, either we call it stimulus or trend, is just the localization of production. So we've seen in a lot of areas where China has become self-sufficient. And I think the most interesting recent example is in technology. If you look at the large technology tool makers or production equipment companies, like for example, Tokyo Electron or Lam Research or ASML in Europe, if you exclude the products that they make in EUV, essentially around 30 to 50% of their sales is being exported to China. So China is still very reliant on some of the most advanced production equipment that is made overseas in markets like Japan, the United States, and Europe. And increasingly, they're starting to develop those technologies themselves. And this is really a combination of having the best companies or improving companies in this area, as well as a top-down initiative to drive increased localization and being less reliant on overseas production equipment companies.
That's
Yeah,
very
if I can
interesting.
just jump in
Yes,
here
please.
and add one other observation that we see in China. So I think historically, when China has really underperformed, a lot of private sector were being under a lot of scrutiny from the central government, and that's led to a decline in returns. I think all of you will have remember all the common prosperity and what it did to the private sector. But fast forward to today, I think that attitude has really shifted. And it is very clear to us, the government, it's now wanting the private sector to be stronger for longer, which is better for the overall economy. And more importantly, to drive investment and innovation in China, right? You look at the CapEx plan of some of the big companies in China, whether it's Tencent, Alibaba, in the last couple of months, they've all stepped up. And if you look at it from the perspective of the central government, it is a win-win, right? It is a win-win because we all want to win in this technology race, right? US versus China in their own different ways, they all want to win. And also more importantly, now the private sector will be allowed to do what they need to do to help China win.
Thank you, Pauline. Now, moving from one end of the scale to the other, do you have any off-benchmark exposure? And that includes sort of the potential to add Vietnam, which is a market that many of our investors are very interested in.
Yeah, I'll just touch on Australia. So just going back to slide 4, I think. Great, thank you. You can see on the left, on the bottom left-hand side, Australia is the largest active weight in the index. As you can see, the weight in the blue bar chart corresponds to the portfolio weight. So Australia, it's not in the index. So I think going back to this point is we're utilizing the full flexibility to buy off benchmark positions. And then this is really captured in terms of the country rate in Australia. It's also a component of across different countries where we own off benchmark positions. And this is really, again, we're not trying to just differentiate the trust for the sake of it. We're looking for bottom up ideas that we think are underappreciated or undervalued by investors. And I think going back to the point we touched on earlier in terms of Australia, we look at companies like Telstra. This is a dominant player in the telecommunications sector that offers a 5% yield, which we think is attractive in Aussie dollars. And the company is able to continually raise pricing and drive, more or less like a 10% annual return to minority investors. We think this is very attractive in absolute terms and relative terms, since this is the reason that we own such a large position in the trust, and which is an off benchmark position. The fund currently doesn't own any businesses in Vietnam, but I'll let Pauline talk a little bit about that.
Right. Before I talk about Vietnam, for our audience has traveled to Australia, I don't know if you have the same experience as I do. When you check into the hotel actually advises you to only use Telstra network and not Optus, which is the number 2 player in Australia. It speaks to the strength that Rob's talking about. And coincidentally, Optus is owned by Singapore Telecom, which is listed in Singapore, where we are zero weight, right? So this is again that differentiation that we are bringing to this trust. On Vietnam, currently the trust doesn't have any position. When you look at what's happening on the tariff side, clearly Vietnam was singled out because in terms of the trade deficit with the US, it ranks actually fairly high, number 3, outside of after China in Asia. And hence, when 2nd of April came, the reciprocal tariff that was slapped on Vietnam was 100%. It's a ridiculously high number. Now, 2 things I want to say here. Number 1, the stock market versus the economy and the implication of this whole tariff thing, right? So a lot of all these exports are actually MNCs that have developed supply chain in Vietnam. These are your Chinese textile companies. These are like your Samsung Electronics in Korea that have set up alternative supply chain in Korea because they want to leverage on the domestic labor force. So when the tariff hits, clearly, what will happen is that the exports will be badly affected, right? Especially if the tariff is as high as what we talked about. And the math, in terms of the math, there's no way Vietnam could import enough LNG or anything from the US to sort of materially reduce the deficit that they have with the US. So that's a very key concern and overhang, unless, of course, Trump decides to look at this whole situation completely differently, which is not impossible, given what we have seen in Switzerland over the weekend with China. Specific to the stock market, there are actually very few companies listed in the stock market of Vietnam that will be directly impacted by this tariff, because a lot of these EMS manufacturing companies are actually MNCs. They are not Vietnamese companies. Having said that, the concern on the Vietnam market would be in terms of the second order impact. If there's a slowdown in investment, there's a slowdown in job growth, wage growth, how that will affect domestic consumption. That is definitely something that is of a concern. And on top of that, when we look at the markets that have corrected a lot because of all this uncertainty and volatility from tariff, we do believe that Indonesia stacks up a lot better than Vietnam. And so that explains why the trusts currently do not have any investment in Vietnam.
Great, thank you. We have officially hit time, but just because we started a little bit late, I might just run over if that's okay with both of you. You've got a couple more questions to go. We'll stick with one on geography, which is actually about India specifically. And there's also one coming up later on the structure of the trust and how you use that investment trust structure to pay dividends. We'll start with the India question, and I'm just going to combine a couple into one, if that's okay. So firstly, the Indian valuations, I mean, the Indian market has come down in the last few months, but valuations to many still seem quite high, despite the pullback. Where are you seeing opportunities here? And then also, when we turn to the attribution side, you can see that India was one of the sort of detractors in the last few months, and the financial sector. Does that mean that the private banks have been one area of particular weakness?
Yeah, well, maybe we can share this question. I think just on India, the observation is correct that valuations are high. And I think there's a couple ways to look at it. The first is you can look at Indian valuations on a price to earnings or a price to book relative to its own history. And, I think post-COVID, India is trading at, all-time highs. And then, and I think importantly for the trust, we look at each market relative to another. And India consistently is more expensive than almost every other market in Asia. But that's also from a top-down perspective. We can look, we're, as we mentioned before, we are a bottom-up stock picker. So we're looking for valuations. We're looking for stocks from a bottom-up perspective. We're looking for businesses that we think are underappreciated or undervalued relative to their growth opportunities or improving shareholder returns and returns on capital. And I think this is where, in terms of the way we're positioned in India, captures this. We're pretty much the largest holdings, which we touched on earlier, are in banks, which we think are attractively valued within India and in relative terms compared to banks across the region in terms of taking into account the growth prospects in India, as well as a couple other kind of areas maybe that are less familiar with investors. So in terms of non-bank financials, for example, companies that lend money either to commercial vehicle owners or lease companies, used car purchasers, and just in general, and for working capital needs. We think these companies can grow their AUM or their loan book by 20 or 30% per year, and they're not priced as such. So I think if you kind of look under the hood or you dig around in India, there are relatively attractive valued companies. I think in terms of the mid cap and small cap space is where we see extended valuations or high valuations. And a lot of these companies tend to be in the CapEx heavy sectors or CapEx focused sectors. Especially over the last couple of years, investors have been looking at or focused on government CapEx, where they're building out infrastructure. And there's a number of beneficiaries in this sector where they're, essentially machinery companies, industrial companies that are going very fast. But we think they're expensive. And at the end of the day, these companies are cyclical. And more recently, you've seen a slowdown in government CapEx. And even just over the last couple of years, you really haven't seen a follow through in terms of private CapEx. In terms of the performance, I'm not sure I totally understand the question. The attribution from India this year is positive. Over the long term, India has been a challenging market for us. And so I'll just kind of highlight a few reasons for that. So it goes back to the first question in terms of valuations that, we think in the last couple of years, Indian valuations are high relative to its own market and versus the opportunities in the region. And I think, one thing that potentially, one mistake we've made or one area we've overlooked is is looking for companies that have very high growth and can grow into their valuation. So we looked, we just mentioned, for example, CapEx opportunities. Maybe 5 or 6 years ago, these were companies that were trading on more cyclical oriented valuations, and they've re-rated sharply. We probably underestimated the potential growth that these companies have hence delivered. And then I think just in terms of some of the holdings that we've had over the years, they've underperformed the market. And I think more or less these are good companies that generate stable returns. They have good governance. And I think in a rising market, these companies tend to underperform. And so those are the two main reasons that the attribution for the trust in India has been negative over the last couple of years.
Thank you, Pauline. Was there anything you wanted to add on India?
Yeah, so actually, I just want to just deep dive a little bit on Rob's comment about NBFC as an example in India, right? So today, the largest NBFC in India is Bajaj Finance. The asset under management of this non-bank finance is close to $50 billion. We don't own this in the trust because we believe that the valuation is really fully reflecting the sort of franchise value. But when we look under the hood, we actually find the next Bajaj Finance, right? In this other much smaller non-bank finance, right? The AUM of this particular smaller one is about $25 billion. Still not small, but half the size of Bajaj Finance. And more interestingly, when we look at this particular company, they have demonstrated a track record of expanding from a single product to multiple products. They started out as a vehicle finance. That book was like 80-90% of their entire loan book. Fast forward to today, the non-vehicle finance book is more than 50%. As they expanded into the category, two very amazing quality they have demonstrated. Number one, in terms of the underwriting, I mean, we all know lending money is the easiest thing to do in the world, right? Collecting money is the skill, is the challenge. They have demonstrated that their asset quality has been in check. Secondly, when I look at the sort of operating expenses as they expanded across multiple regions and category of lending product, they have also been able to keep the OPEX to asset ratio at close to 3%. So this is true differentiation in terms of the modes and quality of the bank. So within non-bank finance, we are able to see this sort of opportunity. It's not very dissimilar to Godrej, the consumer company that I talked about, right? What they are reinventing and innovating to allow the growth to continue to compound in the next 3 to 5 years.
Very interesting, thank you. And then our final question is just on the sort of structure of the investment trust more generally. Now, you've utilised this in the past to pay an income, but that's been expanded recently. You've increased the payout by about 50%. And you've also begun to use gearing on the trust, if I'm not mistaken. Can you just talk us through those two elements, the enhanced income and then the gearing on the trust, please?
Yeah, it's a good question. So I think as investors are aware, the board at the AGM, they announced an increase in the dividend. So the annual dividend yield now or payout for the trust is 6%. And then we've also introduced gearing through CFDs, which is around 5%. But the philosophy and the underlying management style of the fund hasn't changed. We're not trying to necessarily seek high dividend paying stocks to fund that dividend. It's just, for example, we talked about Telstra. Telstra is a good example of a business that we like in absolute terms because it's a very strong business. I really like Pauline's anecdote in terms of visiting Australia and seeing, just the pricing power and the dominance of this business, which we think is underappreciated and not being factored into valuations. And so therefore, it's a relatively large position in the index, and it pays a 5% dividend yield in Aussie dollars. This is in absolute terms, we think this is a great investment. In relative terms, it fits perfectly within the trust. So we're not changing in terms of philosophically our focus on buying companies that we think are undervalued relative to their opportunity in terms of improving shareholder returns or very high levels of growth.
Thank you very much. Well, I mean, we are over time, so I think we will draw things to a close there. It just leaves me to say thank you to Rob and Pauline very much for your time. And thank you to the audience as well for a little bit of patience at the beginning there. Just as a quick reminder to everybody, a recording will be available on the website afterwards should you wish to catch up on anything you missed. And for more information on the JPMorgan Asia Growth and Income Trust, please visit the fund profile on the website where we recently updated the new notes. And now please enjoy the rest of your day, whatever it is you're up to. And thank you very much.